For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. All right, thank you. There, that covers all the thank yous, Professor Plum. Thank you for being here, by the way.
Thank you for having me.
There you go. That covers all the thank yous for the next 3 episodes. Welcome to the podcast, Managing Your Financial Future. I'm your host, Johnny Dean. Our advisor here is Professor Rick Plum, CFP professional, certified financial planner professional, however you want to put it. You got the designation, and doggone it, give me your other one. Manufactured, what?
Yeah, AWMA, Advanced Wealth Management Advisor.
I think I said at the end of the last podcast that I would have that down, and I didn't write it down.
We didn't expect it.
Well, we're back. I'm going to say live, but this is a new episode of the new season. So the last 2 you may have heard, previous fabulous episodes, but I wrote it down at the end and then lost it.
Yeah,
so.
Of course.
All right. Well, anyway, welcome to the show. Okay, so what could trigger an IRS audit?
We're right in the time zone where a lot of people may have already filed
right there.
actually gotten their refunds back. But
yes.
Most people are at the point where they're getting all their stuff together to give to their preparer or to actually sit down at the computer and do their return online or whatever it takes.
Well, that's true. Yeah. So,
especially people that are not getting refunds, they're saying, well, why am I going to file until April 15th?
We're not going to do that.
Why would I pay them until then?
You wouldn't want to do that. So, yes, if you're listening around the time, this is the time it's recorded, of course. The taxes are still, a month, 3 weeks away, something like that. What is the date this year, by the way?
15th.
It is the 15th.
Yeah, it doesn't fall. I don't believe it falls on a weekend this year.
No, there was a time for a while where it was the 17th and the 18th because of this day and that day. But you still have a few more weeks to get your taxes filed. Now, it's important to know, Professor Plum, that while people can file for an extension, it doesn't mean that they don't have to pay right now what they think they owe.
Right, you can file for an extension. They'll give you an automatic extension, but you still have to pay what is potentially what you owe. By the 15th. You can't say, well, oh man, I'm going to owe them $100,000 this year, and so I'm just going to put on an extension and wait another 6 months before however many years.
Yeah, they don't like that.
Now, you do have to follow what they call the safe harbor rules for payment into the system, withholding or estimated payments, either 90% of this year's projected tax bill, actual tax bill, or 100% of last year's actual tax bill, not the refund, not what you paid them in April, but what the actual line that says this is your total tax. You have to pay them 100% of that number. Now, if your adjusted gross income was more than $150,000 last year, you have to pay them 110%.
Is that as a married
number.
Couple?
Married couple or single.
Single.
So it doesn't matter either way. Now, it's the
110%.
110% of last year. So I gave 2 numbers: 90% of this year's, or 100, or maybe 110% of last year's.
Yeah.
Luckily, it's the lesser of those 2 numbers.
Yeah, that's good, because if you somehow had maybe you sold a big property or something and you have a big capital gain,
right? Would
this work where you say, okay, I'm going to go back, I'm going to see what I paid last year.
Yes.
I will pay 100% of that, or 110,
depending on your AGI last year.
I will pay 100 or 110% of that, and I'll wait 6 months and pay the remainder.
The difference, yeah.
Now, do you still have to file an extension to do that?
You still have to file an extension.
Okay,
anytime
so you
go past.
You have to tell them that, and then you pay what you
pay
one of those safe harbor, and then make sure you file.
Otherwise, you'll pick up a penalty. The penalties for a while with interest rates in the tank, back 3, 4, 5 years ago, the penalty wasn't all that draconian. Now they're back to a reasonable penalty. It's a number where it's like, okay, that's going to leave a mark.
That's going to hurt. So let's talk for a second about what would trigger, maybe not even an audit. You don't have to be audited. I mean, just getting the letter.
Audit, you think you're going into the office, you're going to see the guy or the lady behind the desk with a jar of red stuff that's blood from a stone, because that's what the IRS does. They can get blood from a stone. Yeah. And you're going in and they're going through every line. That's what people perceive an audit to be. Those do happen, but those are many levels down the line. Generally, first thing that happens is you get a letter.
In the mail, not an email.
Not an email, not a text.
Never.
Not a phone call.
No.
The only way the IRS will contact you is via letter, email, or postal service, that say they have a disagreement with something on your return. And they are going to change your taxable event for that tax year based on the following information. And they try to lay it out. Yeah, a lot of times you're looking at what they're saying and they don't make any sense. And I only say this from experience because 2 years ago, I got one of these letters. And they told me they were changing my taxable income and the tax owed. And I'm looking at this, but they never said why. And sometimes they'll say why, because there's a missing 1099 or something like that. Sometimes they just say, we've changed it. If you don't agree with this, contact us.
Yeah.
Oh, that's easy to do. So, and I had to go through the process of contacting them and saying, okay, what are you changing? What went on, so that I can decide whether or not I'm right or you're right. No. And I was right.
Okay, you were right. Well, there you go. Let's not say that too loudly because they don't like to be wrong that much. I shouldn't say that. The IRS is actually much kinder and gentler than many of the state tax because
states need more money.
States need the money. The IRS does not.
Yeah,
the states actually use it. All right. Well, let's go through these. There are 8 or 9, and many of these came from the IRS.
Their notices. They're saying, "Hey, people, watch out for this, so we don't have to contact you over this."
All right. So the first one, and I don't know if this is in any particular order, but it may be the first one that may trigger an audit is you didn't report all of your income. This comes under the duh category. But honestly, Professor Plum, I mean, you get W-2s, you get 1099s. You get K-1s.
A lot of people, and for a while, a lot of people were not earning any interest on their bank accounts, and so they really weren't reporting any interest. And now people are actually earning interest on their bank accounts again, and they forget to put that 1099 in or
1099 INT,
and or they cashed in that savings bond that they had, and they just forgot that was taxable interest as well.
That's another 1099. Is that INT or
I can't remember?
It's one of them.
I got one of them this year.
Look at all of your tax forms and all the 1099s. Those are, I think, the most important, really.
Right, and 1099Rs were from retirement accounts. Some people will do what's known as a rollover. They'll take money out of their IRA and within 60 days put it back in. It's a non-taxable event. They know it, and the IRS doesn't know it yet. You have to actually tell them.
Yeah.
And because if you don't put it, even though it's going to show up as a zero net gain, let's say you took 20,000 out of your IRA and within 60 days, put it back in, qualifies for the 60-day rollover. Everything's fine. The money's back in an IRA. Everything's good. You know it. And so you put it down as a zero in the taxable column for the IRA distribution because in your mind and reality, it was not a taxable distribution. But there's a 1099 out there
that's not accounted
from the original IRA that told the IRS that you took X amount of dollars out of your IRA, and they don't know necessarily that you put it back in, so you have to account for it. Show them. There's 2 lines on the IRA distribution. Excuse me, 2 boxes. One in the middle of the page, one on the right-hand side of the page. The middle of the page says, how much in total did you take out of your IRAs during that calendar year, that tax year? And then on the left side, how much of that was taxable? So in my example, you'd put $20,000 in the
how much was taxable?
We took 20 out. How much of that was taxable? None of it.
None of it.
Same thing if you use money to buy a house, first time home purchase, $10,000. Same thing if you got any of the Roth distributions. Let's say I took money out of my Roth before I'm 59 and a half, and I'm taking out my contributions.
Right.
I receive a 1099 because money left that Roth IRA, and the custodian may or may not know whether it was contributions or earnings. They don't even care at that point. They're telling the IRS, and you know that it was just your contributions. You have to account for it.
So the important thing here is to make sure that all the 1099s that you received, even if you didn't get one, but you should know that the IRS should have all the 1099s and make sure that you report all of that. That's probably the biggest thing. They will catch that almost immediately.
Yeah, it's real easy for the computers to look through and match things up like that.
Yes, and remember, the IRS has up to, I think, 6 years to initiate an audit.
Well, if they suspect
if
fraud,
they find
forever.
well, that's true. But if they find a substantial error,
at this level of notification, an actual person probably has not seen your return.
No.
This is the computer looking at normals for your income level, and checking and matching up things.
All right, so you didn't report all your income. That's a big one trigger. Here's a second one here, and these are I have maybe 7 or 8. I don't know. The second one is if you took the home office deduction. Now, that doesn't mean you can't take the home office deduction, but
You just better be able to substantiate it.
That's right. Now you can take it only if you're self-employed or you're an independent contractor of some kind, and you have to use, what did they say here? Part of your home regularly and exclusively for business. It doesn't have to be in a separate room, but it has to be in an area of your home where you don't do anything else. Now, you can deduct your actual expenses, including a portion of the mortgage interests and all that other stuff.
Portion of your phone bill, portion.
But you got to keep records. And you know what? To me, to me, that's not worth the risk because they are really going to look at that.
It is an area that they've looked at, especially now that a lot more people are
working from home.
That don't necessarily have to work from home, but they like to work from home, and their companies are letting them work from home, but they have an office and a place that's being provided for them. So just follow the rules and substantiate it.
If you take the standard deduction, will any of that show up?
Well, that from a self-employed person, it's going to obviously come off their self-employment income.
Well, but okay, I guess so. All right. You could deduct certain $5 per square foot off your home office, all that stuff. I really don't want to get into that, but just know that
if you're doing
the home office deduction is a red flag.
Keep good records.
Keep good records and be prepared to defend yourself.
Defend yourself.
That's right. You said people picture, sitting face to face in an office.
That's not what we're doing yet.
I picture, what was the dungeon with the hanging chains, and the guys with the really
long beards. Did a lot of movies that way.
Yeah, with
the ogre, dragging somebody around.
Exactly. All right, so those two. Here's a third one that could trigger an audit. Besides the home office and not reporting all your income, you reported business losses. Now, you can, of course, report business losses, Professor Plum.
Right.
But they want to make sure you didn't set up some kind of questionable company so you benefit from the deductions. Now,
right. So you can take it. Now, there's a difference between a hobby and a business.
Well, yes.
And so, they don't want you showing tax losses on a hobby in an endeavor that you never expect to make a profit. And you're just trying to take a tax deduction for something you enjoy doing. If it's a legitimate business with a for-profit enterprise where you are in it for the sake of making money, and this year you had more expenses than you had income.
It happens.
That's fine, and it happens from time to time,
especially in the early stages. But if you report losses year after year after year, or you barely break even,
they're going to check it.
They're going to check it, and they're going to want to know why. Now, it says if your business has had a profit in 3 of the past 5 years, the IRS considers it a business, not a hobby.
Right.
And just because it doesn't meet the 3 out of 5 rule doesn't mean that you can't continue to deduct the losses, but you have to be able to prove there has to be a profit motive.
Right. And that's the big number. So it's the 3 out of 5 is a pretty straightforward one. But there's times where you're getting it up and running, and you're showing losses as you're accumulating equipment and other things. And it goes more than 3. Maybe you have 3 or 4 years of losses. That isn't automatically disqualifying the business, but it has to be an endeavor that is for profit.
Yeah,
you have to show that you're not just
throwing money into this thing and
you're not just
losing
writing
money.
off a hobby.
Yeah. And there are good reasons for that. Okay, so that's a third one. Here's another IRS red flag, audit red flag, or communication red flag, is if you had unusually large business expenses. Now, that's what I'm talking about here, business expenses that are larger than other types, similar types of businesses.
Within your income range.
Yes, exactly.
And this is not, I don't know if it's further down your list or not, but it's also if you're itemizing your deductions and you have excessive itemized deductions in 1 year compared to others. 1 year you have a $500,000 charitable deduction.
We'll get to the charitable.
That's all there. Okay.
Yeah, we'll get.
Same with medicals. Yeah, but so business. You got a business that it's been going along, and you've been making $40,000-$50,000 a year, whatever the number is, and then all of a sudden you show huge business deductions. It's not that deductions aren't legit.
Yeah,
but they may raise a red flag, and this is just a red flag where the IRS is going to come back to you and say, "Can you please explain this?" And this is out of character for a business, either for the business that you've been running for X number of years, or for businesses in your category in general. Yeah. And so they're looking for things that are out of norm.
If you have a business, they certainly suggest maintaining a separate business account. If you're self-employed, make sure all your income from that business is deposited into that account, paid through the business account.
And we're talking about red flags. It doesn't mean that it's an illegitimate deduction. It can be very legitimate. It's just that it's out of the norm, and they're going to say, please clarify. And so what we're telling you here is these are things that you make sure that you can clarify.
Yeah, you better. And this is why record keeping is really essential, especially for somebody with a business.
Now, I've never had an actual face-to-face audit, but what I have heard is that if you come in with a box of receipts that are mismatched and just all together,
and you throw it on the desk,
they're going to look at you a lot more closely. If you come in with an itemized, boom, 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 very structured, very systematic, very structured way of doing it, they're going to say, "Wow, this guy's got it together," and they're more accepting of your numbers that way. Is what I've heard. Now, I can't guarantee that, but that's what I've heard.
Well, okay, so and part of that, the red flag is claiming business use of your car for 100% of the time. It may be legitimately so, but you have to keep good records for that. Okay, so that's four of them.
I have seen people question on their mileage on business use of cars, and 100% use and things, and they want to see if you're claiming mileage. Then they want to, every once in a while, they'll ask you for your log.
Keep a log, and you have to be able to have to defend that log.
I think that happened to me 30 years ago. I can't remember if they actually asked for it, but something like that. I think they asked, and luckily I had one.
Well, it's good. You just make sure you have it. Okay, so that's another red flag. Here's the fifth one that I found here was that you didn't report all your stock trades. Of course,
this gets a little wonky or so if you want.
Well,
some people
it's like
do
a 1099-B.
1099-B shows your sales and proceeds from stock transactions. And some people have, fairly large accounts, or they trade a lot, and they've got a lot of transactions.
Yeah.
And it's how you go about. I've seen people Schedule D on the tax return.
That's the gains and losses.
That's the form on the tax return where you show your gains and losses from your from your capital asset transactions.
Yeah.
And I've seen some people, and I don't know which way is exactly right, but they'll say, okay, account number XYZ at this brokerage house had a net long-term capital gain of this. And they only put the net numbers down, but they identify the account it came from. Each account, boom, boom, boom. And other people I've seen put every single, their Schedule D is 42 pages long. I think that the first one is fine, but I'm not the IRS, so you don't
quote you on that. Don't take that to the bank or to the IRS.
And say, hey, Professor Plum said I could do this. They're going to say, first, we don't know him. Second, we don't care.
Oh, the guy from the Clue game, huh?
Yeah, that guy.
And then Colonel Mustard and those guys. So make sure you report all of that. Again, that comes down to reporting all of your income.
Right.
Now, if somebody
also report your basis correctly. This is an issue, especially if you had stock that you've had for a long time and you only recently sold it. So I bought Apple in 1994 when it was 40 cents a share or something, and I finally got around to selling it. The only thing that the 1099 is going to show are the proceeds for those securities. Securities that are what they call uncovered. There was a new law that passed in 2010 that said it's now the brokerage responsibility to keep track of your basis, what you paid for it. Prior to that law going,
we had to do it ourselves.
It was up to the individual.
Yeah.
Now, anything that the IRS leaves up to the individual, they found is just fraught with people lying through their teeth,
or just simply
don't know.
It's too complicated.
Maybe my grandparents bought me Disney stock when I was a kid, and it'd been in my name forever, and I'm going to go sell it, but I have no idea what grandma and grandpa paid for it, and they're no longer here to ask them.
Or those dividend reinvestment programs.
Well, then you got to keep track of every dividend reinvestment. So, but a lot of people that are selling stock, they may have paid $40,000 or $50,000 for it, or they inherited it from grandpa, in 2009, and it was
anything like that.
There is a basis, but that's not being reported. If it's an uncovered security, the basis is not being reported. So make sure that you do report the basis so you don't have as big of a gain to pay taxes.
Right. And don't go too far on the basis. Make sure it's correct. There's a balance there. Yeah. All right. So what we have so far, the 5 of them we've mentioned so far, is that you didn't report all of your income. That's a big red flag, of course. Another one was you took the home office deduction. You reported business losses, maybe too many, excessive. Or you had unusually large business expenses, and you didn't report all your stock trades. Those are 5. Here are a few more for you, just to keep in mind here. And I know not everybody has these things, but you may run across these during your lifetime. This, I understand why. If you didn't answer the question about digital assets, now, We're talking about these virtual.
Cryptos.
Yeah, and I'm only mentioning that word I'm only saying that
because the IRS is looking for it.
Yeah, I'm only mentioning this because this is what the IRS says. They ask about these virtual currency transactions on the front page. They've been doing this on the front page of the Form 1040 since 2020, and they expanded it. So I think last year it says, at any time during 2023, did you receive as a reward, award, or payment for property or services, or sell, exchange, gift, or otherwise dispose of a digital asset or a financial interest in a digital asset? Now, you have to answer that question, yes or no. If you do not, it's certainly going to slow things up for you,
right.
But it may also trigger an audit because this is stuff that they're really going after.
Right, because, I mean, one of the allures of the crypto world way back when was because people thought it was tax-free.
No.
That has been debunked.
It's a risky game, and I don't want to say anything more about it for compliance reasons.
Answer the question appropriately. If you have dealt with, I mean, my son-in-law dealt with it. He had maybe $500 in it, but he had to say yes to it, and then that has follow-up questions.
Yeah, of
he
course.
answered it legitimately and everything. He's never heard anything from the IRS. I, on the other hand, have not had any cryptos, and so I answered no, and I've never had any question from him yet.
Yeah, I am not. We are not making any suggestion about buying or forget that.
Well,
I'm not talking about investing in it. I'm talking about what the IRS will look at, and that is a question on the form.
And we're not talking about stocks, bonds with buy or sell.
No,
either.
we're not doing any of that stuff. Just want to make that clear. Okay, so answer that question. 2 or 3 more here. A red flag. This is one. You started to mention this. If you made large charitable contributions or you didn't include documentation for them. Now, fewer and fewer people, it seems nowadays, at least as with the tax structure as it is, are able to deduct these because they're not itemizing. They're taking the standard deduction. This was the first year that I couldn't from the federal side.
Right, but if you live in a state that has a state income tax, you still want to keep track of them appropriately because you can deduct them at the state level.
Yes. There are a whole bunch of different rules for this. If you're making a donation, it's your responsibility to get the proper letter. So that says, yes, you donated this amount. Yes, you have to have that, and you need to keep that letter.
And you should have some kind of an itemized list of what you donated so that you can back up the fact that, you gave the items to charity. Now, what happens is if you're retired or not retired, you're making 40 or 50,000, and you show, a huge donation of things one year, they're probably going to ask you, what happened? Where did it come? Or if you're donating very expensive items, very expensive related to the income that you've
non-cash kinds of things,
or even cash. Where did it come from? But things that are, again, like I mentioned earlier, out of the norm, out of character for somebody in that income category.
I read somewhere that they have the computers will look for norms, and based on your income, there's a certain amount that
they expect somebody to have either given to charity and they'll accept it without basically even questioning it. But
sometimes, but you may just be randomly
you're outside
selected.
that norm, they're going to maybe ask you for the documentation to back it up.
Yeah, so be careful if you're itemizing and you make these large charitable contributions or you don't have the proper documentation for them.
Did they say anything about large medical expenses? I'm waiting for a letter on that one.
They did not, but
I unfortunately had the opportunity to take a large medical deduction a couple of years ago. I have the documentation. I have it all. And
you're just waiting.
I'm waiting for the letter.
You're waiting. You're waiting for
way out of character.
Yeah. You keep running to the mailbox like 4 times a day. So watch out for that on the charitable contributions. Make as many as you want. Absolutely
be
fine.
as charitable as you want.
But understand.
On the same charitable side, I've had this question asked several times over the past couple of weeks. Where does a qualified charitable distribution show up on my 1099? Now, qualified charitable distribution is a distribution from an IRA directly to a charity for somebody who is age 70 and a half or older. And we have people that have done qualified charitable distributions, sent it directly, lived up to all the rules, and then they get their 1099-R, which identifies what is taxable from or what is a distribution from an IRA. And they say, where on the form does this say I made a qualified charitable distribution? And the answer is nowhere. There is nothing on the tax form that identifies a qualified charitable distribution. You have to account for that on your tax return. And so somebody who doesn't itemize can take this money out of their IRA give it to the charity and have it be a non-taxable event. But you have to account for it on your tax return. You do. It's not on the form. It's not on the 1099.
What do you do? How do you account for it?
Oh, you make sure you communicate this. Yes,
no.
But you make sure you communicate it with your tax preparer.
Or if you're doing it yourself.
If you're the type of person that just takes all your tax paperwork and gives it to your tax preparer, and they don't have a whole lot of time to spend with you, and you say, well, I'll come back and get my tax return when we're done with it on April 15th, that tax preparer has no idea that you did a qualified charitable distribution. So you have to tell them, and then the preparer will account for it correctly. If you're doing it yourself, yes. Now, what I've seen are the tax softwares that most people use. I haven't seen anybody use paper and pencil lately. The tax software for somebody who's 70.5 or older will ask, did you do any charitable contributions with this distribution?
Yeah.
So hopefully they're walking you through it, and
I gotta think they are.
I've seen it. The one that I've seen, I'm not saying every software does it, but the software that I've seen does ask, but it won't ask unless you're 70.5.
Well, of course not, because
but make sure that you put in the proper, so you get that deduction.
Yeah, it's very important that you do that, and it's kind of a way to get a de facto deduction for even if you don't itemize.
It's definitely, and I would do this even if I did itemize. I would want my QCD to be top of the line.
Absolutely. Okay, so you made large charitable contributions. Let's do just another, one or two more maybe. This is almost sounds like a no-brainer. It's you could be audited if you earned a lot of money or very little. So according to government data, the IRS in recent years has audited taxpayers with incomes below $25,000 and above $500,000 at higher than average rates. I guess
higher than average rates for what?
Well,
I'm missing
no,
this one.
they audit. There's an average audit. There's an average audit rate of whatever it is,
so the people above 500. When you make, the more money you make, the more likely you're going to get audited.
Yes, but apparently it's also if you make very little money, under 25,000 seems.
There's a lot of people under 25,000, especially in the retired world.
It doesn't mean it's not legitimate, but what we're saying is that they tend to audit those at a higher rate than the average audit goes. You know what I mean? It may not be that much higher.
I wonder if it's people that had incomes of X and now are showing incomes of.
It could very well be
much lower than X.
Could very well be, and it may not be an audit. It may be a letter. I don't know.
I know people.
It happens all the time.
We're making 100, 200,000 a year working, retire at 61, 62, and they aren't eligible for Medicare yet. They've got millions of dollars in their IRAs, and they've got a bunch of money personally, and they live off the personal money and keep their income very, very low until they get to 65, and they get the subsidies from the Obamacare type ACH.
Yeah, it's perfectly legitimate.
But you're going from 150, 200,000 or more down to 25,000.
Yes, but in that example,
30,000, and so expect a letter saying, "What's going on here, boys?"
You may, but I don't know how high the audit rate is on that. It may not be very high.
I haven't seen anybody. Nobody's come back and told me they were being audited on that or questioned.
Just know that could do it. Last one here, very quickly, because we're almost out of time, is that you made some kind of error. It says you make errors. If you make error, well, you put the wrong Social Security number. If you
transpose the number,
if you rounded, here's one. If you rounded the numbers for your expenses instead of reporting the actual dollar amounts, like if you put, I have $1,000 of advertising, I have $500.
Nice round numbers.
They don't like that. If it appears that you just yanked it right out of the air, for some reason they're going to question it. So. Because they know it's very unlikely that you're going to hit round numbers every single time.
Like that
you're just, so just know that if you have expenses.
And I know people that will go through it towards the beginning of the tax filing season and put in placeholders when they're doing, a preliminary. They'll put in, 10,000 for advertising, this, that, and the other thing. And so they put in those numbers expecting to come back and put in the real number later. And then they forget that they did that. And so they'll send it off that way. And if you do that, expect a letter.
Just expect a letter. So very quickly, what happens if you're audited? Professor Plum, generally they're going to send you a letter. They will only send you a letter through the mail, through the U.S. Postal Service.
And they're going to say, we are changing your return for the following reasons. Tell us why we shouldn't.
Yes, basically. And you have a certain amount of time to respond. And if you don't respond, or they'll assume you accept it, and they'll say, okay, you owe this much, and then you have a certain amount of time to pay it. may include penalties and interest, depending. But they say just make sure when you respond, have documentation, send them clearly and concisely just on that particular. Now, the face-to-face thing, Professor Plum, I think
unusual.
Generally that comes.
Well, it's after several letters.
Usually.
Several layers of this going back and forth.
Right. And in many cases, not all, but in many cases, these things can be resolved through the mail or correspondence.
Right. Now, if they will adjust, in some cases, they will adjust your return as they issue this letter. And so let's say you were getting a refund. And
then you'll minus
they change, they say, well, you owe us an extra $500. So and you were going to get a $1,500 refund. They're only going to send you $1,000. Now, that's not all that common. That's usually only happening with paper returns.
Yeah.
Because when you file electronically, most of the time they're just processing and giving you the return and giving you a refund. And then they'll come back and look at it and send you out the letter saying, we want to adjust something. So you could end up owing us back that $500.
You got to write a check.
If you're paper filing, which takes a lot longer, if they find an issue or have a question, they will, in many cases, adjust your refund if you're receiving one.
You're going to adjust it very quickly like a chiropractor. Just, ow, oh, that hurts. Ow.
And ow is the right term.
It may be. These are the red flags to look for. We wanted to do this. I know doesn't have anything to do with strategy, but really, Professor Plum, it does in a way because, all of these things come down to tax management and tax planning.
Right. It comes down to making sure that you're not paying too much in taxes. And also, a lot of retirement planning is maintaining a certain emotional well-being, a stability of your anxiety levels. Yeah. And I don't care how good your record keeping is. You get a letter from the Treasury and a question from the IRS. You're right, but you still if you get the letter, your heart skips a beat or two. It stinks, man. It just your blood.
Don't take your blood pressure as soon as you walk in from the mailbox.
And it can make you mad. And it's just one of those are things that we like to avoid.
It's looking at the envelope.
And if
Professor
it's easy to avoid, let's avoid it.
I got my a month or two ago. I got my there's an identification number, a security number, like a four-digit thing that you
PIN number or something.
Yeah. You have to have a PIN that you put in when you e-file your return.
Oh yeah,
it's for security.
Yeah.
Well, they sent that to me in the mail. Of course, they're going to send it in the mail because that's what they do. All I saw was this letter from the IRS. I thought, I was just homina all the way into the house. Anyway, so yes, we want to avoid that. Professor Plum, you guys at Lucia Capital Group work with tax management all the time. This is part of what you do. You
do not do your taxes.
We do not do you do not do your taxes, and that's what I want to make clear.
We do not do your taxes. You need to do your taxes.
You work with the tax management side of it, and hopefully, the goal is to make sure that you pay as little as you absolutely have to pay.
We don't want to pay anymore. It's an expense that we want to manage to the low side of the world.
Give Professor Plum a call. Now, give any of the Lucia Capital Group advisors a call. Professor Plum, I know you got a meeting coming up here, so I don't want to keep you, but give him a call, 800-644-1150, 800-644-1150. Go online, luciacap.com, LUCIACAP.com. Find a lot of this information online, videos, articles, blog posts, etc. Don't forget to subscribe to our podcast, Spotify, Apple Podcasts. Either one of those works. Download every episode to your device and listen away to your heart's content. Professor, thank you again so much. One more thank you.
Welcome.
Absolutely. For Professor Rick Plum, I'm your podcast host, Johnny Dean. Thanks for listening. Talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. No client or prospective client should assume that this information or any component thereof serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with, and securities and advisory services offered through LP
LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.